Energy stocks have done much better than the rest of the stock market in 2022. We can say that many investors have had a very hard time this year. The S&P 500 index is down 14% so far because of inflation and rising interest rates. But despite this weakness, the energy business is doing well. The Energy Select Sector SPDR ETF has gone against the trend and gone up 59% since the beginning of the year. This is because oil and gas prices have gone up, which has led to record profits for those in the industry. Energy companies made a lot of money this year, which let them pay off debt and give their shareholders bigger dividends. Even though energy stocks are up a lot, events that affect supply could make oil prices go up even more. Recently, the Biden administration stopped letting out 1 million barrels of oil per day from the U.S. Strategic Petroleum Reserve. Also, more European sanctions on Russian oil will go into effect on December 5, and the US and other G7 countries want to put a price cap on Russian oil. All of these things could make it harder to get oil from Russia. Do energy stocks belong in your portfolio, given the chance of more changes in the energy market? Here are 3 things that you might want to buy right now. 1. Exxon Mobil is getting ready for a future with less carbon emissions. Exxon Mobil finds, makes, and moves crude oil, natural gas, petroleum products, and other petrochemicals in the US and around the world. The company has been in business for a long time and recently said it would raise its dividend for the 40th year in a row. This shows how strong the business is and how well it has managed its money over the years. It has gotten more money from the higher prices of Brent crude oil, which are at their highest since 2014. Exxon Mobil's revenue grew by 59% from the same time last year to $318 billion, and its net income grew by 202%. It also made $22 billion in free cash flow, which is money it can use to pay down debt, reinvest in its business, or give to shareholders through dividends and stock repurchases. Since its long-term debt peaked at $69.5 billion in the second quarter of 2020, Exxon Mobil paid off $24 billion of it. It is also putting money into its business to get ready for the change to green energy. It invests in carbon capture and sequestration, or CCS, which is the process of capturing carbon emissions and then moving and storing them safely somewhere else to reduce the amount of carbon released into the air. The company thinks that the CCS market could be worth $4 trillion by 2050, and as part of its efforts to cut carbon emissions, it has promised to invest $15 billion. It has also done well by its shareholders, giving them $11 billion in dividends and buying back another $10.5 billion in shares. Exxon Mobil is a good energy stock to buy today. It has a dividend yield of 3.08% and $30 billion in cash on its balance sheet. 2. Devon Energy is a company with a lot of cash on hand and a good dividend. Devon Energy works in oil exploration and production in the upstream. Last year, the company set a new trend when it announced a fixed plus variable dividend policy. This gives investors more money when oil prices go up. The fixed part of this dividend comes from 10% of the company's quarterly operating cash flow, and up to 50% of the variable part comes from free cash flow that is above what is needed. The company made more money and had more free cash flow because oil prices went up. Devon Energy paid out $6.20 per share in dividends over the past year. This gave shareholders a great return of 8.9%. Investors should keep in mind that the yield on dividends can change a lot. Devon's dividend was $1.37 per share in the third quarter, down from $1.55 per share in the second quarter. This is because the company's free cash flow went down because oil prices went down. Devon Energy is on track to make a record amount of free cash flow of over $6.3 billion this year. This will put the company in a good financial position to pay dividends, buy back shares, and invest in the business. Devon Energy bought 2 oil properties in a deal that will increase its cash flow by 25% in the fourth quarter because it had a lot of cash on hand. This is another good energy stock to add to your portfolio. 3. Occidental Petroleum. Less debt means that shareholders will get more money. This year, Occidental Petroleum may be one of the better-known energy stocks, thanks in large part to Berkshire Hathaway's aggressive buying. This year, Berkshire Hathaway has increased its stake in Occidental Petroleum to 914 million shares, which are worth over $14 billion. In 2019, Occidental bought Anadarko Petroleum for $55 billion, which left it with a lot of debt. Higher oil prices helped it make more money and pay off a lot of its debt. Since its debt was at its highest point in 2020, when it was $37 billion, Occidental paid off almost half of it, bringing it down to less than $20 billion. If Occidental can get its debt down below $20 billion, it will be back in the investment grade category. This will lower its cost of capital and save it $350 million in interest payments. The stock will also get a boost from the fact that the company will start giving more cash back to shareholders through dividends and buybacks of its own stock. Occidental also plans to invest in the CCS business. It will use its existing assets and know how to capture and move CO2 from one place to another. This gives the stock great upside potential from here on out and makes it yet another great energy stock to buy right now. Please don't forget to subscribe for getting stock updates. Thank you for watching.